Hi, I'm Elizabeth with SCAPE, the Southwest Colorado Accelerator Program for Entrepreneurs.
And I'm Cory Finney. I'm one of the two managing partners of the Greater Colorado Venture Fund.
We're here today to have a conversation about how investment funds work, what type of companies we're looking to invest in, and how to help companies navigate if they're a good fit for any of the investment funds in the area. So we are constantly asked a lot of different questions, and so we thought it would be a good idea to kind of record our most asked questions and answers when people reach out to help people navigate this process. One of the first ones is we get asked of, what type of investment and how does it work? So investment funds are usually looking to invest in a company either through equity or some type of revenue sharing or redeemable preferred stock. How this differs a little bit from your small business loan or bootstrapping is that an equity investor, they are investing in the business in exchange for a certain percentage of ownership of the business. And those terms are all determined on a case-by-case situation of what works for the investors, what works for the founders. And there's a predetermined agreement of how the business is going to be run, how the investment is going to be spent, and the hope is that it will be on a liquidity or an acquisition plan down the road so that investors can recoup their investment. There's also revenue sharing or redeemable stocks, which is where an investment is made with a predetermined schedule of a buyback term sheet so that the founder can maintain ownership and buy back the stock at different multiples over different years. So there's different ways that investment can get structured depending on the goals of the business, the founders, and the interest of the investors. A lot of the times the equity investors are looking for certain returns to come back to their portfolio. Cory, could you elaborate a bit on fund math and the returns that a portfolio is expected and how that factors into investment decisions?
Yeah, the common thread in everything you just said is it comes back to liquidity. And the reason it comes back to a liquidity event, and that's through an acquisition, is through a merger, it's through an IPO, or through this equity buyback, revenue buyback. The reason we need liquidity events is because we're managing a pool of capital that a bunch of private investors have put their funds into. So we're managing GCVF, we're managing on behalf of 60 different individuals, institutions. They put their capital into one vehicle and they contract us to manage that. We invest that into a portfolio of companies. So call it 20 to 30 companies over a 3 to 4 year period. And during that period, statistically, out of those 20 or 30 investments, the math says that a third are going to go to zero, a third will return 1x capital, and a third are going to be where the returns in the fund are made, right? Yeah. And so the way that works is we need to be looking for opportunities that can get us 10 times our capital back in our investment if we're going to be in the top quartile of what we do. So to be in the top quartile as a venture fund manager, you need to return 3x on your fund over a 10-year life period. And so to get that, we're looking for those 10x returns on individual companies that hopefully end up covering the 1x and the zeros so that we can then return that capital back to our investors and we can continue this cycle of investing.
Great, that's a great way to explain it. It's also, founders need to consider that the type of money investors are putting up, it's incredibly risky because it's completely illiquid. They can't get the investment out of the business in a year or if they change their mind. If someone invests in real estate or in the stock market, it'll fluctuate and go up or down, but you can usually still pull out the bulk of it. And so the type of investing we're talking about, we are locking it up for such a time period that we have to be able to demonstrate to investors and to the fund that the risk return is worth it and viable at the end of the day.
Well, that's finance 101, right? Risk return.
Yes.
The more risk there is, the more return
Yes.
you should expect. And that's why venture lives in probably the most expensive category of types of capital that you can access is going to be venture capital. Because when we say return, I'm talking about a rate of return of about 30%. So if you went and you got a bank loan, you might be looking at 8 to 15% maybe. So we're looking at really, really high return rates that we need to see on our capital. And it's to justify the risk that we're taking. Otherwise, the investors wouldn't be giving us capital. They would be putting it into much safer bets, getting a little bit lower return, right? But they want high high returns, and that's what they expect from our asset class. So
Yes.
it's, I think, tough to explain that to entrepreneurs sometimes. It's like, well, it's $1, it's green, it shouldn't matter, right? It's like, well, unfortunately, our dollars have a little bit different expectations than dollars from a grant or dollars from a bank or dollars from, a CDF hire program, whatever that may be.
Great. Okay, no, that helps a lot. Because at the end of the day, everything is it's going to be gauged by the market size and the opportunity of the business and how much it can grow and expand to then provide that return to the investor. Could you maybe give us an overview about how the Greater Colorado Venture Fund is structured and how it works?
Yeah, we're structured like most venture funds, and I think it's really important for entrepreneurs to understand how venture funds are structured, because that helps you understand what the incentives of investors are, so that you can understand if you're a good fit for that venture fund. So the way that it works is we have a pooled vehicle of capital. So there's a bunch of private, and it might be an entity, it might be an individual. In our case, the state is one of our investors. They all individually put money into a pooled entity, and then we are contracted to manage that entity and deploy that entity across a portfolio of investments. So we'll take that pool of capital, and for us, we're going to invest it in 25 to 30 companies over a 3 to 4 year time horizon. And then once those individual companies sell, that money goes back to the holding company, and then we distribute that back to the investors who've given us capital.
Great, thanks. And that's similar to how the SCAPE investment funds work. We too have pooled funds where every year we have additional local investors provide us the capital that we then make the investment decisions. For the SCAPE program, we primarily invest in companies that have gone through our Accelerator so that we can help flush out the due diligence and put them on the path to success. But at the end of the day, it's kind of the same model of multiple investors have pooled their money into these funds, and then they are managed by the SCAPE investment funds or the Greater Colorado Venture Fund to administer the investment, report on it, and handle any returns or liquidity events down the road. It's very similar. So one of the primary questions we get is trying to explain what is a good fit for either angel investment or venture capital funding. And a lot of that comes down to the definition of what is a scalable business or a growth business. So could you share with us how you guys define scalable and what's a good fit for your fund?
Sure. We think of scalable as being headquartered locally but able to bring in revenue from a national base, or even better, an international base. Yeah. So that could be oftentimes, a software company. It could be a product company that's selling its clothing in 6 different continents. Generally, they share characteristics that they have high margins. So we're looking for high margin businesses. And then I like to say it's like, if the business can make money while you're asleep, then it's probably a scalable business. If it can't make money while you're asleep, a service-based business, then you probably don't fit into that scalable bucket for us.
Oh, thank you. That's, we find there's a lot of really good business ideas out there that are better served by bootstrapping or small business loans, because what we're looking for to invest in is something that can be scaled and repeated and isn't dependent on one person to either provide that service or that offering. We often get approached by service providers such as chiropractors or wellness centers, and while those are great business models, there's not an avenue for an investor to participate. There's not a way for them to help grow the business and then get a return on their money. So I sometimes joke that until we can clone people and to automate that, we can't really push them on that investment path. So I'll second what Cory said of what we're looking for with those software and those scalable companies. It's something that an infusion of money will help really get to the next level, that there's a product or an idea where the margin and the numbers work, that if we can provide more resources, we can exponentially increase who the customers are and who we're selling it to hopefully generate returns for the fund. Both of our funds are really motivated by supporting companies that are local in Colorado at this early stage, and supporting them in a way that if they have a successful exit or liquidity event, it enables additional investment in other companies down the road. So that's why we try to be good stewards of the investments we're making so that we can keep the cycle going and support more companies.
I think your point about exit events is really important because that kind of ties into the scalability, right? Like there's not a defined path. If I start a restaurant, there's typically not a defined path of who's going to buy my restaurant 6 years from now. You generally start a restaurant to run it, to be cash flow positive, to earn a great income in your community, and to potentially hand off to your kids or something of that nature, right? And so, you know, coming back to the structure of venture funds, we have a fund that we have to return to our investors. And so our obligation is to at some point have a liquidity event so we can get that capital back in the hands of our investors. And I think oftentimes that's lost on entrepreneurs, and it also helps fit like who's a good fit for venture capital and who's not. And it's those businesses that can scale. They have a more defined exit path traditionally.
No, thanks. That helps a lot of kind of explaining to boil it down to people of what we're looking for. Because there's a lot of good resources from Startup Colorado or local small business development centers and local banks that are really well equipped to help those companies with the type of funding that's more appropriate for what they need. And when we say appropriate for what they need, it's usually a more affordable type of money for the company and the founders to use to help themselves grow. And it makes more sense with what their growth plans either might or might not be. You know, another important thing, they ask us a lot of how long does it take to raise money and what do they need to do to get in front of investors. Cory, could you kind of give an overview of when you're talking to a company and walking them through of what to expect and what they need to bring to the table?
Yeah, so the statistics show that it takes on average 6 to 9 months to raise a round of financing. Yeah. And you might not be actively having investor conversations during that time, but you need to build a pitch deck. You need to build a data room. You need to get all your corporate docs together. All this needs to like get organized, and we can hit on diligence and a little bit of what we want to see in a diligence checklist, but you need to be prepared to enter into the diligence process with an investor once you finally have those conversations. Then there's another period where you're just curating a list, and I like to tell entrepreneurs it's a numbers game. You can't rely on only talking to 1 or 2 investors to get the capital you're going to need. You need to have a long list. When I had my company, I think I spoke with over 150 investors, and eventually, 15 of them invested. So you need to have a long list. You need to be prepared for no, and then you need to build the relationships. You need to get out. You need to figure out how to network into the funds. It's easy. Funds like us, like we're pretty public-facing and approachable. Yeah. Whereas if you're trying to raise angel capital, that might be a harder segment to break into and to gain that audience, right? So you have to understand your audience. You have to get inroads into your audience. And then once you finally get in front of an investor, then you have to build the relationship. And that's the hard part. And that's the part that takes time, right? Because we like to say that investors invest in lines, not dots. So if you just send me a pitch deck, that's one dot and that's one data point. I need now to create my line, right? And so if I can look at company updates, then that helps me see what have they done well, what's been going, what hasn't been going. I'm going to have a couple meetings, a couple conversations with you. I'm going to talk to your co-founders. So as you can see, this just becomes a lot of in-person time, and it's relationship building. And at the end of the day, our job is to find the best founders, and there's a lot of trust that comes with that. And so that process in itself is usually at least 7 touch points. So when it's all said and done, it's not hard to be in 9 months to raise a round of financing.
It is definitely a lot of effort in talking to the right people when the business is at the right time. It's important to recognize if the funds you're talking to, if that is an area of interest. You want to make sure you're having the right conversations with the right people. And also make sure that your story and your pitch deck and what you're presenting has enough traction and it's accomplished enough that you have a story that they can follow along and see how, if they support it, it can help get it to the next level. Some of the mistakes we see in pitch decks are that they just kind of show the idea of what the dreams and the hopes are, not of what has actually been accomplished to date. So could you give us an idea of what you like to see as far as traction and what progress they've made and how that helps influence an investment decision?
Yeah, for us, it's funny. It really depends on the stage of the business, right? So we may see a
Yeah.
business that is just at the idea stage, and that entrepreneur needs to sell us on the dream. They might not have any traction and they need to
Yeah.
sell us on the dream. That's usually not the stage we're investing. We're usually investing at what we call the seed stage. And for us, that's at least 6 figures in trailing 12-month revenue. They know their product margins. They've been able to test sales or marketing and start getting some feedback on what is or isn't working. But they haven't quite hit that inflection of the growth curve, right? Where they're really taking off. And so we like to see a solid line of kind of customer and revenue growth over a period of time. I like to say we come in, if companies are born, they crawl, they walk, they run. We come in at that phase when they're kind of taking their first steps but still falling over. And then we try and get them walking, and then we try and get them running. And then at that point, hopefully they're hitting the inflection of the growth curve, and they outgrow our support and they move on to the next round of investors.
That's great. And it's, at SCAPE, we are at a little bit earlier stage than the Greater Colorado Venture Fund. So we've got good synergies of different levels of support. We are willing to look at businesses that are a little earlier with their revenue and their idea to help them down the path to get themselves positioned to where they are ready to have that story of what they've accomplished and how they can demonstrate growth and the viability in their marketplace. Could you elaborate for us, Cory, on kind of the market size and why that's so important for businesses when they're looking to talk to investors and they're starting to have those valuation conversations of kind of assessing their opportunity?
Yeah, market size is important because you need to be able to have room to run is kind of what it comes down to, right? And so when we're looking at a business opportunity, we're evaluating, is this typically what you're going to hear in ventures? Is this $1 billion idea? And a lot of that just comes down to what can the potential exit be with this company? And, unfortunately, we have to say no to a lot of companies because they don't meet the market size criteria of what we need for our fund to make money for our investors who've entrusted us with their capital. That can be a really painful process. But generally, we're looking at, can this play in $1 billion market? Is this idea in $1 billion market? And then is this a team that can win significant market share in that market? And those are kind of what we're looking at from a high level when we're starting to.
That helps. One thing that we get asked a lot is about what it looks like to begin fundraising and what information that companies need to work on to get ready to have those investor conversations. And most people need to have a well thought out pitch deck that explains what they're doing, what they've accomplished, where they're going, how the capital infusion will help accelerate them getting to that next level, and then importantly, what is that kind of exit strategy of how an investor is going to get their money out. There's a lot of legal documents that need to get prepared, of shareholder rights, which are essentially the rights of the shareholder of what they're buying with that investment. That can be of what type of reporting they're entitled to get, if they have any voting opportunities and how the business is run. There's subscription agreements of when you are writing the check to the company, you are subscribing to the terms of the round, and that explains what you are actually buying and what the rights are in the company. It's important that there's a very clean capitalization table that shows any money that has come into the business to date, how people are being compensated, if there's employees with stock option or warrants. It's very important to make sure that everything is set up properly from the beginning to be able to grow and bring in other investors. So there's a big lift in the fundraising process to make sure that all the paperwork and everything is structurally ready, in addition to having it be a viable business opportunity at the same time.
And all the paperwork that comes before the investment ever happens, like founder vesting agreements and IP assignments, and there's a lot of just corporate documentation that you're going to need from the get-go. And when you come to folks like us, it's really helpful to have that in place, because if not, that becomes an immediate road bump, and it becomes something that's like, okay, well, we need to go back and we need to get a founder agreement in place. We need to get a vesting schedule in place for the equity that you've given your co-founders. And you need to create a cap table in the first place so we can see what there is, right? So there's a lot of paperwork pre and post, or I guess as the investment's coming together, to your
Yeah.
point?
I mean, I'm guessing it's probably 20 things.
Easily.
I mean, and so part of what we have to do is make sure that all of those 20 documents are handled correctly, and then we help articulate them to other investors to see if they are willing to come into the opportunity. So that's partly why we have to make sure that everything is, all the boxes are checked, everything makes sense, and the numbers work.
I'm curious, because so much of this work is getting done, you're getting really hands-on. How does that then translate into how you might engage with the company post-investment versus how another source of capital might engage with the company?
So at SCAPE, we kind of joke that our companies never leave because we help them through the Accelerator process of building their business and working on all this paperwork. And then if we are one of their first investors, we continue to help them as they grow. So we might do follow-on investing in additional rounds when they're ready to bring in the larger funds and other partners to the table, and continue to help them as they're needing to raise different types of money or different situations or navigate potential acquisitions or potential partnerships and increased hiring. And so oftentimes the venture fund becomes a partner with the business that can help grow and navigate through different steps and different needs. Usually at this early stage, there is a lot of support that's going to continue to be needed. And so the SCAPE funds, the Greater Colorado Venture Funds, we all continue to be engaged because we're motivated to make the business viable so that we can make the investment viable so that we can keep funding and programs going.
Yeah, no, it sounds right. It's from our experience, we see like a bank, you're not going to get that level of hands-on experience, right, from
Yes.
a bank as you would from SCAPE. And that's good and bad because sometimes an entrepreneur may only want 50 grand and they don't want to hear from you. And that's fine,
Yes.
but I also think then that venture capital is probably not the right fit for that entrepreneur.
Yes. It's important also that when people are investing in a business, whether they're an angel or a venture capital, that you're aware of those expectations and those relationships from the beginning. Because they can take a lot of different paths, but it all boils down to communication. You know, in our shareholder rights, we expect that we'll get quarterly financial reports, we'll get updates. And that's so that we can help monitor how the business is going, and so we can help head off any struggles or any challenges or connect them to the right people that they might need to navigate something. And so it's kind of an all hands on deck approach, and I think GCVF operates the same way. We would rather know about something and be able to help with it than find out after the fact.
We always joke, this is a little morbid, but the average marriage in the US lasts 7 years, and the average time to exit from seed investment is 7 years. So when we're supporting entrepreneurs, we really are committing to a long-term relationship with that founder. And we want that trust to be there so that listen, I love when the good things happen, but I know more often than not the bad comes with it. And I want to be the first call when there's bad so that we can lean in, we can bring our network to support, and we can really go to work for the entrepreneur. So a little bit different.
And that is what the rewarding part is that yes, you help them along the joys and the growth, but also helping when they are tired and exhausted and they need that support system and other people that can help their business or advise or help talk through something with them. That's the other key value that comes from angel and venture funds, is the right people helping at the right time.
Totally. How do you think about if an entrepreneur is trying to understand, is their audience venture capital? What questions should they be asking themselves? What are some of the things they should be thinking about?
They should be thinking about the margin of their business, and if they're having a product or a service, how much money it takes to create that and then sell it. And if there's room in there for expanded growth with additional capital. And it also depends on how many customers there are. You know, if you're dependent on foot traffic into a business, that's likely not going to be enough people to have the math and the spreadsheet end of investment capital work. You're going to have a large enough market and enough of a margin on the product that it makes sense to partner with investors. And then there does have to be that potential liquidity or acquisition or exit plan so that the investor can get their money out. The majority of our investors are motivated by the support of the community and the value and the benefit they see there, but there has to be a way for them to recoup this investment to keep it going. So some type of liquidity event. We can't take investors' money and lock it up for 20 years. That doesn't do anyone any good. And so we try to help explain the paths they need to get on to see if they're a good fit.
Totally. So a founder gets to the door, they check all the boxes, they have a scalable business, great margins. Why do you feel that they should come to SCAPE over another investor in kind of the wide realm that is the investor options?
So it's pretty special, the offerings that SCAPE provides local businesses or regional businesses in Southwest Colorado, that if they are at that level where they've got a viable product and a little bit of traction and it's a good fit for them to work with investors, we are well equipped to help them with all of this paperwork that they need to get ready and to help perfect their pitch deck and their story, and then help them shape which investors they're going to try to get in front of and why they are targeting those investors. Could you talk about how you help companies navigate of what type of fund and at what stage it makes sense for them to go after?
Yeah, for us, a lot of it comes down to the traction of the company, and then to your point of trying to help them get in front of the right audience. Like, that's incredibly important because you can waste so much time talking to the wrong investors. You can spend, and I've done this as a founder, where I've gone out and I chased all these investors that were never going to say yes because I was too early. But I kept trying to convince them that I wasn't that early. But the reality was they only invest in companies doing 6 figures in trailing 12-month revenue, and I had an idea. And so really helping narrow down that audience and focus on who is the right, what stage are you at, and then what's the subset of investors that serve that stage, and then what's the relationships we have that can accelerate getting in front of them. That's kind of some of the process we go through with our companies.
Oh, great. That's very helpful because that's what the companies need. Is there's a lot of different information out there, but knowing how to navigate it and what to approach at what stage and how it might be received, that's part of what SCAPE and the Greater Colorado Venture Fund do, is help companies navigate which path to go on at what stage. So thank you, Cory. We really appreciate your time and all that Greater Colorado Venture Fund does for the area. And so we encourage people that, if this helped you kind of navigate what is scalable and what is a growth business, to reach out to us if your business fits those parameters. Thank you.
Thank you.